Thanks very much for having us here. This is joint work with Evgeny, Lyandres, and Alexei Zhdanov. Both of them are right here in the audience. We're starting with the question that I think a lot of us thought about. So growth options are arguably one of the most important component of the firm value. At the same time, they're very difficult to value for a number of reasons. So number one is that it's very hard to project cash flows of a growth-oriented firm. So think of your favorite growth-oriented firm. So that turns out to be hard. Second is that the risk of the firm changes as the options moneyness changes or when the options get exercised. And the usual valuation techniques that are used by analysts such as DCF or multiples are usually inappropriate because if you think of implementation of a typical DCF, people usually don't take into account the changing nature of risk as the company exercises its growth options. So in this paper, what we want to do, we want to understand how well growth options or investment options are valued by the market. So we're going to go about doing it the following way. So we're going to construct a general real options model of firm optimal investment under uncertainty. We're going to estimate this model on a broad cross sections of stocks, and we're going to obtain a theoretical or intrinsic, you can think of it as intrinsic firm value for each firm. After that, we're going to compare that to the actual observed market value of the firm. So we're going to construct a measure of misvaluation, so you can think of it how far the actual firm market value deviates from the theoretical intrinsic firm value. And then we're going to analyze this measure. So we're going to analyze its properties. We're going to look at how it is related to risk and returns. And then we're going to try to link that to the growth components of the firm value. So what we do here is related to a number of papers. So the first one is paper by Egor and my co-author Alexei Zhdanov. So they look at the valuation of default options and they show that default options are misvalued. Varusa with Arana and Whited have a paper where they quantified the effect of equity mispricing on firms' optimal investment and financing decisions. So in our paper, we're going to bring misvaluation to the firm level, and we'll try to link misvaluation to the growth components of the firm. Leonid and Dmitris has a series of papers where they started looking at investment-specific shocks that affect differently the value of growth options and assets in place. So let me tell you exactly what we do. So we start with the model, and so it's a model of investment under uncertainty. So a firm owns a capital stock K. It generates free cash flow that is proportional to some demand shock X that follows geometric Brownian motion. The firm can be scaled up at a cost of physical capital eta. It has decreasing returns to scale, and the returns to scale parameter is theta. Capital depreciates at the rate of lambda. So in this model, the optimal investment policy of a firm is the following. So you have to wait when the shock X crosses a certain threshold level, capital X. At that point in time, you invest optimal amount, exactly as much. What that brings you back to the optimal investment boundary. And so the solution to this model gives the firm value that can be easily decomposed into two parts. So the first part is the value of assets that are already in place, so the existing assets, which is just a simple present value, discounted present value of firm's EBIT at the appropriate discount rate. And the second part is the value of the firm's growth option. So what affects the value of assets in place and growth options in this model? So I'm going to tell you how exactly different parameters affect that. So the lines on top, the solid line, that's the value of firm's assets in place. The dashed line is the value of a growth option. And so the value of assets in place decreases with the depreciation rate, and it makes perfect sense because as the faster capital depreciates, the faster the value of the assets in place go down. The value of the growth option increases in lambda because the faster it depreciates, it is more optimal for you just to invest more. But the total value of the firm, of course, decreases with depreciation rate. The volatility of the cash flow It affects the value of the growth option positively, of course, and it doesn't affect the value of assets in place. And so the comparative statics on the value of growth option with respect to the productivity parameter, it increases. The value of assets in place increases as well. The value of the assets in place is not affected by the cost of capital because that capital is already installed. But the value of the new capital, the value of the growth option that it can be installed, decreases in the physical cost of capital. Okay, so this is the model. Now, so we're going to empirically implement that. And so the way we're going to do it, so we're going to take two firm level inputs. So first one's going to be property gross PP&E, which will be, in our model, will be K, so capital stock K. The second one will be firm's EBITDA, which in our model will be just the pre-tax value of the firm's outputs in our model. So this is X times K raised to the power theta. So after that, we have 5 parameters that we need to identify. So the parameters of the demand process, depreciation rates, the physical cost of capital, cost of physical capital, and the returns to scale parameter. So the identifying assumption we're going to make here is that firms within industries have same parameters of all 5 parameters. So some of these parameters that we can identify in the data well, we're going to estimate them outside of the model. We're going to calibrate them. So in particular, we're going to take the parameters of the demand process. So the drift and the volatility. So the drift we're going to estimate based on the analyst's long-term forecast of the long-term growth rates. For the volatility, we're going to base that on the seasonally adjusted quarterly volatility of sales. Depreciation rate is going to be based on the depreciation rate of PP&E that we observe in the data. So that leaves us with 2 parameters, which is the returns to scale parameter and the cost of physical capital parameter that we have to estimate. So the way we're going to estimate is the following. So we're going to construct the theoretical firm value, and we're going to compare it to the observed value in the data, so the market value of the firm. So we're going to define the measure of misvaluation, which is just the ratio of market value of the firm over the intrinsic theoretical value of the firm. So by this definition, so the firms with a misvaluation ratio that are greater than 1 is going to be overvalued firms, and the firms below 1 will be undervalued firms. And so we're going to find these parameters by just minimizing log misvaluation within each industry over the past 12 months. So that minimization is going to give me the values of parameters theta and eta. And so these are estimation results. So first I'm going to show you the returns to scale parameters. So here they are aggregated by sector. In the paper we do it by industries, and so the parameters range from 0.26 to 0.46. The second one is the cost of acquiring or the cost of physical capital parameter. And so it ranges from 1 to 1.36. So the way to interpret this parameter is the cost in dollar value, you can think of it. So how much does it cost for a firm to install new capital that when you install it and you put it on your books, the book value of that capital is $1. So 1.36 would mean that you have to pay $1.36 to install capital that is worth $1. So the way to think about it, it's either this capital is very firm specific, or it's just installation cost that you have to pay extra to install that capital. And you can see that in our results. So in industries such as sectors such as energy and materials, so these estimates are pretty high, suggesting that capital in these industries might be very firm specific. While in other industries such as information technology, that parameter is pretty low. So finally, as the result of our estimation, so we can find and we can decompose the firm value in the value of growth options and assets in place, and we kind of can put a tag on how growthy the firm is, right? So we can measure for each firm the ratio of growth options to assets in place, and so these are the results. So they range anywhere from 73% in healthcare and 53% in information technology sector to very low numbers such as 3.4% in materials. So there is a very large deviation. On average, we find that growth options relative to assets in place constitute about 30% of the firm value, which is significant. Now, so what I'm going to do, I'm going to try to externally validate this model. So what I mean by that is that I will sort all the firms into based on their growth options to assets in place ratio and try to see what the observable characteristics look like. So this is in this table. So up top here we have firms that have least growth options to assets in place, and the firms at the bottom here have most. So you can think of the firms at the bottom that are growth-oriented firms. Firms at the top, less growth-oriented. So firms down here, they have much higher market-to-book ratio than firms at the top, which makes sense. In terms of age, firms down here, they're a lot more younger than firms up top. So the firms with a lot of growth options, they're just younger firms. If you look at R&D, so firms with a lot of growth options invest a lot more in R&D compared to firms with fewer growth options. In terms of asset growth, they grow much faster compared to the firms with fewer growth options. Leverage there, firms with a lot of growth options are not that leveraged compared to the firms with fewer growth options, which makes economic sense. They have higher equity betas. They have higher standard deviation of returns, and higher fraction of these firms is listed on NASDAQ. Okay. So now, in the final parts of the paper, we will try to link misvaluation, growth options, and future returns. So I'm going to start by analyzing the properties of this misvaluation measure that we derived. And so here, we're going to sort all firms into undervalued and overvalued deciles, and try to, again, look at the observable characteristics, how they look like. So here, we see the kind of inverse U-shaped pattern. Firms at the top, they're much smaller, and firms at the bottom, much smaller. So both undervalued and overvalued firms tend to be smaller compared to the firms in the middle of the distribution, which are larger. And so now I'm going to show you all the other characteristics, and they're going to, for the most part, they're going to exhibit the same U-shaped pattern. So if you look at age, so both undervalued and overvalued firms tend to be younger. So firms in the middle, they are older. In terms of R&D, firms in the extreme deciles, they also they invest more in R&D. So in terms of past returns, so overvalued firms, they have much higher past return compared to the firms on top. So they have return run up there. So that's gonna be important when we're gonna look at factor loadings in a minute. In terms of standard deviation of returns, so both undervalued and overvalued firms also have higher standard deviation of returns compared to the firms in the middle. In terms of analyst coverage, firms in the extreme deciles have fewer analysts per firm that they covered, and they have higher forecast of the analyst dispersion of analyst forecasts. Okay. So in the interest of time, let me skip this slide. And let me show you how returns look like for this firm. So what we do here, we sort again firms into misvaluation deciles. So firms here, most undervalued firms here are most overvalued. And so the first column shows you the mean returns. So these are monthly mean returns in this portfolio. So these are value-weighted portfolios, by the way. So the firms, the undervalued firms, on average earn 1.05% per month. Overvalued firms 0.15% per month. So the difference is large. So it's 90 basis points, and it's very significant. So now we're gonna control for risk. We're gonna consider several models. So we're gonna start with just CAPM, and we're gonna do Fama-French 3-factor. Gonna add momentum to that. Fama-French 5-factor momentum Q. This is Legendre Q. Factor model, and we're going to add momentum to Q. And so here what we see is that the worst performance among all the models we have in the Fama-French 5-factor model. So this gives us the lowest alpha, but this alpha is very statistically significant, and it gives us 82 basis points. So we'll try to explain why, for example, the performance goes down. So from 90 basis points, we go down to 78 when we control for HML and SMB. And when we add momentum, why that alpha goes up. And so that has to do with the factor loadings. And this is what's shown in this table. So because undervalued firms, of course, are more they're value firms by construction, and overvalued firms, they're less. So the difference between the undervalued and overvalued firms has very significant positive loading on HML, and that's why when we control for HML, so the performance of the strategy goes down. The second part, the interesting part in this table, is the momentum part. So here we have, so just because the undervalued firms had lower prior return, the overvalued firms had higher returns. So it means that undervalued minus overvalued is the strategy that is contra momentum. And that's why when you control for momentum, we have much higher alphas. And so you can see that undervalued minus overvalued is loaded negatively on momentum. Okay, and so these results, so we do a number of robustness checks in the paper. And so the results that we present here are very robust to a number of departures from the methodology that we have here. So first, so I showed you the basic results when I sort everything into deciles. So if we sort into quintiles or just binary classification based on which stocks are undervalued and which stocks are overvalued, we have very similar results. So the results actually much stronger in equally weighted portfolios, which is usually the case. And the results are also robust to allowing for, our baseline doesn't allow for industry level misvaluation when we estimate the model. We depart from that, we allow for average industry level misvaluation. Our results are robust to that. And so they are robust to some other modifications that we do, such as industry classification that we use in this paper. Okay, so now the last part. So what I want to do here is I want to link the returns that we have to undervalued minus overvalued stocks to the growth component of the firm. And so here what we're going to do double sort. So first I'm going to keep my undervalued and overvalued sorts, so constructing undervalued minus overvalued portfolios. But the second part, I'm going to sort on the growthiness of the firm. So firms at the top of this panel, so they have lowest value of growth options relative to assets in place. So you can think of this as not growth-oriented firms. And firms at the bottom here, they are more growth-oriented. So these are the firms that have the highest fraction. So most of their value is actually derived from growth options and not assets in place. And so if you look at the results, so these are the alphas. So at the top panel, we see very little, and so most of the alpha is coming from the bottom panel. So it means that this spread in the returns to undervalued and overvalued stocks comes primarily from firms that have a higher fraction of growth options relative to assets in place. All right. So the second thing we will do is very similar to the previous table, only here we sort, so we do the same double sort, but we, instead of sorting on the ratio of growth options relative to assets in place, we sort on the ratio of market to book. And so here we sort on the industry level value of market to book, because that by construction, the way we estimated our model, by construction, this is orthogonal to our misvaluation measure. And so here you can think of it as a fully independent sort. And the same thing as we've seen in the previous table. So most of the results that we have to our UMO strategy comes from the firms that have highest market to book ratio compared to the lowest market to book ratio. And so let's try to interpret what these results mean so far. So what we've showed you is that the model identifies firms that are mispriced relative to existing asset pricing models. And that, of course, can be due to two reasons. So first is there is some systematic mispricing that comes from potentially many sources. For example, growth options are really hard to value. Second, it may be some behavioral biases and attention. And number two, of course, it can be still a risk story, because this UMO spread may simply capture some really unique source of risk that is associated with growth, or the growth component of the firm, that is not captured by the risk factors that we use in our empirical tests. And so in the last part, I'm going to present you 2 additional pieces of evidence. So one would be the model without growth options, and the second will be the performance of undervalued and overvalued stocks during the times of high and low sentiment. So first, let me explain what is the model without growth options. So we're going to do exactly the same exercise as we just did, but when I would estimate the model, I would shut down the growth option component of the firm. So the value of the firm would just come from the existing assets that the firm has. So it will simply be the estimated value of the perpetuity of firm's EBIT. And then I'm going to also construct misvaluation. So I'm going to take the market value of the firm divided by this model firm value. I'm going to do exactly the same sorts, and we'll look at alphas. And so what turns out is that doing that would not give me any alpha, and our interpretation of this is the following. So if there is some source of risk out there that is associated with growth, it would be there in this counterfactual model as well, and it would show up as alpha in this regression. So the fact that it doesn't show up as alpha, it means that what previously we documented might be due to the mispricing of growth options. And the second part, so we're going to look at the returns of the same trading strategy, so UMO, during times of low and high investor sentiment. So the idea is that, a number of papers show that during the high investor sentiment, so firm values are more likely to deviate from their fundamental values. And so here what we find is that results are much, much stronger during the times of high sentiment. So you can look at just the returns to mean returns, undervalued minus overvalued, they're 1.68% per month. Even when we control for existing risk factors, they're 1.55%. So that's large. And during the times of low investor sentiment, they're much lower. And so finally, so what I'm going to do here is I'm going to take the times of high investor sentiment, and I still want to link that to the growth component of the firm. So here I'm going to do the same double sort that I did before. So I'm going to sort it, all the stocks into low GO over AP ratio and high GO over AP ratio. And I'm going to show you that most of the results, again, come from the subsample of firms that have high value of growth options relative to assets in place. And so our interpretation, so these 2 results show, so the model without growth options gives us no alpha. Results are stronger during the periods of high investor sentiment. And so this suggests mispricing of growth options. However, it still may be partially due to risk, but if this is a risk story, it has to be risk that is very unique to the just growth components of the firm. And so to conclude, so what we do in this paper, we look at the growth options. We start with the premise that they are hard to value. We apply a real options model to value the growth components of the firm. We show that undervalued growth-intensive firms outperform overvalued growth-intensive firms. And evidence that we have suggests that it's mispricing of the growth options, but they may be still partially due to the growth options-related risk factor. So thank you.